Nobody asked for another podcast, so here you go. This is yet another Infra podcast.
Hey everyone, we gathered here for a special recording to talk about the SVB saga and everything that is going on. And we have a couple of people here that all have a different view on the situation. And so hopefully we can provide some additional information that's not exactly the same that you've heard a million times before. So Chase, maybe let's start with you. And can you tell us a little bit more about the history that predates what just happened with SVB?
So the history is actually one of a regulatory unfolding, and it dates back to the 1980s. So prior to the 1980s, regulators were, still spooked by the things that happened in bank runs and financial crises prior to then, and they used to evaluate the substance, basically, kind of the financial health of the bank by looking at what was actually happening like underneath the hood. And I think that we could potentially introduce an analogy here to describe what I mean by substance. So if let's say I'm building an apartment building and we want to understand what could happen in case of a fire. And, before the 1980s, regulators used to come in and say, what measures did we put in place to make sure that if the fire happens, people can get out safely? And then in the 1980s, something shifted. Two things happened. One, Alan Greenspan kind of led the charge to shift the burden from regulators to shareholders via risk disclosures. And regulators started evaluating processes instead of substance. And so using this analogy we drew earlier, processes would be the equivalent of not necessarily looking what I did to make sure we could get out of a fire, but instead saying, well, if they have someone on staff whose job is to figure out what to do if a fire happens, we're going to be able to use that as a stamp of approval. And then when I say something about risk disclosures, we're basically saying, as long as the apartment building has some requirements that they have to tell their owners around the risks that they're taking, we can rely on the owners to evaluate those risks and determine whether that apartment building is still viable. And so, this is one part, the banks lobbying for reduced regulatory burden, which justifiably that makes it harder for them to achieve profits. And this is also one part, the downsizing of agencies capable of evaluating the substance, basically the quality of the financial system, the health under the Reagan administration. And so this problem really came to a head in 2008 when the regulatory framework, finally led to the first big bust due to excessive risk taking. And it shouldn't have been that much of a surprise, because if we're saying the shareholders, the people who are benefiting from the profits of the companies, are the ones who are in charge of evaluating the health of the companies based on their risk disclosures, it's always going to bend towards more risk because they're always chasing returns. Higher returns are directly correlated to the amount of risk you're taking. And so if I want to make more money, I got to take more risk. And that obviously blew up in 2008. And we don't have to necessarily talk about what the sources that were, because that's been well documented. And so then in 2008, we got stress tests. And a stress test is basically a measure of a bank's ability to withstand an economic downturn. And so these regulatory stress tests came into place where regulators said, hey, you've got to tell us and show us what your plan is in case your building burns down, in case the world unfolds, in case there is a bank run, in case you become insolvent. And they set the threshold at which banks had to do this as $50 billion. And so fast forward to 2008, and legislators passed a bipartisan act called the Economic Growth, Regulatory Relief, and Consumer Protection Act. Fast forward to 2018, and legislators passed the bipartisan Economic Growth, Regulatory Relief, and Consumer Protection Act, which increased this threshold from $50 billion in assets to $250 billion. So now they're saying, hey, if you are below $250 billion in assets, you are no longer subject to reporting on these stress tests. And we're primarily going to rely on procedural instead of supervisory oversight. Procedural, hey, if you've got the compliance people in place, and if you're reporting out on making your appropriate risk disclosures, then you're not subject to, kind of this deep substance review by regulatory agencies. And around that same time, there's this bank with fewer than 50 billion in assets called Silicon Valley Bank. And before 2018, this bank had fewer than 50 billion in assets. Fast forward to 2022, they have 211 billion in assets. And so the amount that this bank actually had under management was below that 250 billion threshold and was therefore not subject to this, to this regulatory oversight.
So, Steve, a lot of ink has been spilled over this last week about the Fed's involvement in the situation, what the Fed should have done, whether they were fighting the last war, and so on. So maybe you can expand a little bit on that.
First of all, Chase, you just nailed that. I think what's interesting about this crisis is that everyone is seeking to place blame everywhere except the place where it's most obvious, which is, and so Silicon Valley Bank made a huge bet on interest rates about a year ago. And a bunch of other people made a big bet on interest rates a year ago. And what happened? The Fed raised rates by 4.5 percentage points, which is insane, both on a percentage basis and also just on an absolute terms. They have not done a raise like that in decades. And you can argue what happened is it's all Silicon Valley Bank's fault for making this big bet. And that's true. But the reality is it was this massive rate rise more than anything that just pulled them out from being underwater. And to give some context, at the beginning of last year, I think the maximum super crazy expectation for the Fed raising rates was something like 1.5 percentage points, maybe 2. So then you sit there and say, well, the Fed did this bold act in order to slay inflation and they just kept raising because the standard issue playbook that we read in every single place is that, oh my God, the Fed is all powerful. The Fed does everything. And all the Fed does is yank this interest rate button up and down. And the macroeconomy just responds with grace as if, et cetera. The reality of the last year is that the Fed kept raising rates in the macroeconomy, which is the real economy, people going to work every day, just ignored the whole thing. Now, the asset economy, the stock market, got obliterated. And the things that depend on assets, like, for example, Silicon Valley Bank or the massive real estate fund that just shuttered inflows and outflows out of Blackstone about 6 months ago, that, by the way, to me is the first canary that died in the coal mine. All these things are looking both stretched and ugly. So the point, let me just sidestep out here, is Silicon Valley Bank's problem is, okay, they made a big bet, but more importantly, they had to take a bunch of assets that they had marked to a total fantasy number and mark them back down to what they would actually get if they sold them in the real market today. Big newsflash. Every other bank is sitting on some quantity of those assets, and they are all worth just as much as Silicon Valley Bank's assets. These are not weird, exotic things. This is not 2008. These are boring, stable, mortgage-backed securities. They're worth what they're worth, and the reason they're worth a whole lot less is because the Fed raised rates so high. Pulling that back to right now, the question is what have we gotten for all those rate rises? Has inflation plummeted? Has unemployment skyrocketed? None of this has happened because, in fact, what's driving all this inflation and all these issues is just a pure real economy supply-demand equation. And the fantasy was always that the Fed, by yanking this one lever, which is the only macroeconomic lever that we're willing to tolerate, was somehow going to have an effect on it. So that's the setup for where we are right now. The setup from here is pretty clear, and the market has figured this out. There's a 96% chance right now out there that by December, we are cutting rates. And the reason we're cutting rates is not because inflation has been killed, because we were never really going to do much against inflation by cutting rates. The reason we're cutting rates is because otherwise we're going to destroy the financial system. And the financial system's kind of important. So when it comes down to it, I think the Fed's decision choice here is either we keep raising rates in this sort of quixotic effort to kill inflation, where the point being that the Fed can't create more oil, they can't create more used cars, they can't create more labor. And that's the reason prices were going up, one of the reasons. Or we cut rates because the whole thing was kind of a failed effort, or we destroy the financial system. And the only thing I would point out is the Fed the original charter of the Fed back in 1907, when they finally kind of got their act together, was built out of a bank run. And the reason the Fed is there to protect the banks. The whole inflation mandate didn't really show up till 1977. And the whole 2% inflation target, which everyone treats as if it's this holy relic that, must be venerated to all time, didn't show up until 2012. And when you get down to it, if we end up at 3% inflation with a non-destroyed financial system, we are probably better off than at 2% inflation with a destroyed financial system. And my assumption is the Fed next week is going to figure that out. So that's the short version of the rant as to where we think we're going. I could be wrong. I still think the economy slows down because prices are high. But in all that, I think the context of the thing we're going to need to take away is that this sort of utter faith that we have a one-factor economy where we just yank this rate lever up and down and that somehow drives the rest of the engine. has died a very ugly and very public death. And that's going to be pretty interesting to see how it goes forward.
Playing off that, I think everyone has this concept that in 2008, all the bank crashes because all of the exotic financial instruments are created. There was this, Big Short movie about it that they did a great job explaining it. But what it seems, SVB was not actually playing that game. So Chase, can you explain maybe what happened? Because it seems like SVB did invest in very safe assets and still collapsed.
So a little more history. I'm playing the role of the historian here. So you're exactly right. They weren't actually transacting in these like wild securities like we saw in 2008, the ones that bore the excessive risk that we talked about earlier, but they were actually buying safe securities. They were buying mortgage-backed securities, which I know that had a really different definition back in the day in terms of the underlying assets, but these were safe assets, and they were buying fixed income treasuries from the Fed. But it was exactly the purchase of safe securities that was problematic. So here's how to think about it. Most banks take deposits and make variable rate loans to businesses. Variable rate meaning the interest rate on the loan increases as the Fed rate increases. And then banks pay more on deposits, which are basically depositors making loans to bank when interest rates rise. If I go to a bank and an interest rate is 5% and they're only paying me 2%, that means that my real return on that is minus 3%, meaning my money is depreciating and I don't want that. So they have to increase rates on deposits. And the spreads between what they earn from the loans that they're issuing and what they pay in deposits is actually how banks make money. And as rates rise, with most banks, the rates that they pay on deposits increase and the rates of the loans that they've made also increase. And many times that spread is actually increasing. And so profitability improves. The problem with SVB is the majority of the customers are startups, which don't typically generate free cash flow and therefore don't typically take corporate loans. This is why they raise equity from VCs like us. And to generate yield and to pay interest on deposits, SVB bought long-term fixed rate assets like treasuries and mortgage-backed securities. And so when interest rates actually started to rise, the interest that they were paying on the deposits surpassed that they were earning from these fixed rate bonds. And so, the TLDR here is, what did they do wrong? Well, they incurred an excessive amount of interest rate risk. And I know it's easy to look at the bank and say, oh, well, it's not their fault. The interest rates went up. Like, how could we have expect them to foresee this? And I think that kind of is the point. The bank's job is to be a risk manager and actually take the right kind of risk. And they took an excessive amount of interest rate risk on their portfolio, especially when you look at this relative to the other banks that were out there.
I was just going to pitch in with one thought on that as well, which is just to step back and where this isn't some crazed tinfoil hat anti-Fed rant. It's just math. The Fed has raised rates to 4 point something percent. If you look out 5 years or 10 years, you go to the market and you say, what can I borrow at I'm going to get about 3.5% right now. So there's about a 1 percentage point difference. It is not hard to figure out that if you're a bank who has to pay deposits on that 4.5%, whose only ability to lend is going to be getting about 3.5%, you're losing 1% a year. And that's what the inverted yield curve really just means. It means that short-term rates are higher than long-term rates. And for a bank, that is a flat out hard math money-losing proposition. It's also a money-losing proposition for anyone else who is trying to do anything in the asset economy. So just to pitch that in, this is where the market is telling us the natural rate out there should be about 3.5%. And the Fed's cranked it up, and that's fine. But there's no God-given reason for that. And more importantly, it mechanically will destroy the profitability of the banks over time.
So I actually just have a question, which is in the grand scheme of things, with all of the stuff that's happened over the last couple of years, like COVID, interest rates going up, et cetera, I'm vaguely surprised that we've only seen two somewhat large banks fail. And I'm curious to hear from people who know better than me, how much can we realistically hope like regulation is going to prevent stuff like this in the future? Is this really something that we can just regulate away completely? And if we assemble the right rules, we'll end up with like a really great system where this never happens again and everybody is completely safe, but banks still function as normal? Or is this kind of part of the inevitable tidal flow of the way the financial system actually works?
I actually took the class of the guy who got the Nobel Prize for looking into bank regulation about 1 or 2 years ago. So I actually know something here. The thing about banks, and Chase has said this very well, is they are inherently unstable. The whole system is structurally unstable because you are basically taking in short-term deposits that can disappear tomorrow, and then you're lending it out or putting it against longer-term assets. And that, no matter how you set that up, that's always potentially at risk for a bank run, which we've just seen. And so to answer your question, there is no actual regulatory fix for this except what you've seen right now, which is number one, you take care of the depositors because it wasn't their fault. And by the way, the 250,000 number has always been somewhat a fantasy. What it's trying to protect against is, bank over here is offering 2% interest and failing bank over here is offering 5% interest. Anyone who goes after that 5% knows damn well that they're taking a lot of risk. That's what that limit is intended to stop. But otherwise, depositors are always going to get made whole. But the idea that we could somehow have a free market banking system, there's no math, no academic research, and one very big Nobel Prize that says, no way, not going to happen, got to be regulated. And the whole system is just inherently stable. It's like a quantum. If it collapses, it collapses.
Alex, you asked a question about is it possible for regulators to actually help here? I'm not going to necessarily speculate on what's possible, but I do want to emphasize the importance of them actually being involved in this process. Because I'll repeat a statement I made earlier. Whenever we as a depositor go to a bank, we are actually lending the bank money. We are in that sense underwriting, we are lenders to the bank, and therefore, there's some onus to underwrite the creditworthiness of this bank that we are giving our money to. But we as depositors shouldn't be responsible for underwriting the creditworthiness of our bank. One, because we can't get access to that information to make these judgments. And then two, none of us are sophisticated enough to actually do that, or very few of us are sophisticated enough to do that, present company not included. And so this is what we're hiring regulators to do. This is their job. Their job is to basically give me confidence as the consumer that when I put money in a bank, that they are credit worthy enough to actually be a good steward of the dollars that I'm giving them. And so Steve brought up an important point, which is FDIC insurance. And so this is the $250K amount that regulators will guarantee whenever you put money into a bank. And they're saying look, no matter what happens to this bank, we are going to promise you that $250,000 is safe in this bank. Above that amount, we actually can't say. And one of the problems is that a massive percentage of their depositors had larger deposits than 250,000. And I think that number is sitting somewhere around only about 7% actually had deposits below this threshold. So that means that 200-ish billion that was sitting in the bank, the majority of it, or 94% of it, was actually uninsured. And so then it raised the question, well, what is the fix here? Do we increase the FDIC amount, this insurance amount? Well, the problem with this proposition, and I don't know what the fix is, but I'm just giving, the bank side of the argument. The problem with this proposition is the banks are the ones paying this insurance. They're the ones filling this fund to insure their depositors against some bank run or bank failure. And so if we go to the banks and we say, hey, we need you to insure all of the deposits entirely, well, then of course, insurance premiums are going to go up, and that's going to hurt bank profitability, which is already a low margin business. And if bank profitability hurts, then banks can't really exist. And so it's kind of a catch-22. And so I think maybe the thing we should be considering is not, is 250,000 the right amount for a bank? I think the thing that we should be considering is what percentage of deposits are uninsured. And if that percentage crosses some threshold, that's when regulators should actually shift from procedural oversight back to substantive, saying, hey, we're not just going to say, hey, you've got your person saying that the fire escape is good, so therefore your bank is safe. We're actually going to look under the hood and make those assessments ourselves on behalf of the depositors who have hired us to do this so they can safely put money in the bank.
Let me just pitch in, Alex, to answer the other question that you kind of implied is why haven't more banks failed? And more importantly, what's going to happen in the future? What you want to imagine is sort of a conveyor belt, and that's just time moving on. And we've got a whole bunch of people who are basically holding their breath, or I'm now mixing metaphors. As the conveyor belt goes along, it leads off a cliff. And Silicon Valley Bank just fell off the cliff, and so did Signature Bank, and another bank fell off the cliff. there's a lot of other people who have more cushion, so they can lend at 3.5% and borrow at 4.5% for long enough that they're not going to go bust quite yet. But as the conveyor belt moves along, they too will fall off the cliff. And this, I think, goes to why the market has suddenly priced in a rate cut, is that it's a situation where the few weak caribou die quickly, or the few weak canaries in the coal line die quickly. And then you get a warning and then you step back. If you don't act on the warning, then more canaries die, more caribou die, and then you get a mass die off, because no one can lend at 3.5% and borrow at 4.5% indefinitely and stay in business, because math doesn't work. So that's the super simple version of where we are right now, and why, if you look forward, we will either see more bank failures or we will see the rate environment adjusting.
So let's talk a little bit about more of the role of the regulators and stress testing for that environment, because what it seems to me that happened is we're just fighting the last war, right? The previous war. We stress tested the bank for credit risk, which was the majority of what happened in 2008. But it seems like with SVB in particular, there was a lot of money that came almost out of nowhere. It wasn't that the bank suddenly became amazing at business and, they kind of increased their asset under management from 50 billion to like 200 billion. It's really what happened there is their risk profile was completely different than what happened before. And it seems like no one actually was paying attention to that profile of risk. So I would love to hear more about that.
Which is a pretty interesting point, because it reminds me a little bit of like why we take our shoes off at like airports, right? We're like the, airport security posture is fully prepared for like the 2001 threat and may or may not be prepared for the future.
Yeah, I'll pitch in where I'm maybe not so worried is to take your point of that people are always fighting the last war. Is the one good piece of news, is per Chase's comments, it's kind of the last war. If there's one thing that we have a playbook for that we understand, it's your classic bank run. We know how to handle them. And if you look at SVB and how it got handled over the weekend, okay, it was chaotic. A lot of people got worried. But broadly speaking, we opened for business on Monday. They did the right thing, which is take care of all the depositors. And we're clean. And if the next bank that fails also does that, we've got a playbook to handle that. So we don't have a Lehman crisis. We don't have a Merrill crisis. We have a Bear Stearns crisis, unlike 2008. The bad news is, just because we managed to win a few battles, and this is where you get to this issue, it doesn't mean we can just put up with an indefinite string of bank failures, because the banking system is kind of important. So that's where you run into great, we're okay in the near term. We fought the last war, but we also know where this leads.
So you made a statement like classic bank run. I actually think that we have a new flavor of bank runs that we have to figure out how to deal with, because the systematic risk used to be financial, meaning if one bank is financially unstable, what happens if that bank goes down? Is it going to bring down the rest? And this is a very calculated exercise, right? Like, what is the risk exposure that this bank has on the rest of the system? But right now, the bank run or the systematic risk of a bank run is no longer just financial. It's also cultural. And look no further than the GameStop saga as proof of that. And then we'll draw that forward to what we saw most recently. The GameStop saga was one example of the power of meme velocity that should have been an oh shit moment for regulators. And so when I say meme, what I'm talking about is Richard Dawkins' definition, that he wrote in a book back in 1976, which he defines a meme as an idea, behavior, or style that spreads from person to person within a culture. And, since then, this has been reappropriated by the internet. But the point is, there was a meme that these hedge funds who are betting against GameStop, which was a very rational decision at the time. Like, this business wasn't as good as it used to be. Things were shifting online. And there was a reasonable business case to be made that GameStop was not a great business. But the internet saw it differently, and the internet came together with rapid fire and brought down GameStop. And so we think about meme culture here and what happened. The irony of this whole situation is SVB was totally solvent. They had more assets on the balance sheet to cover deposits than there were deposits. But whenever there was some concern with SVB's irresponsible handling of interest rates, all of a sudden meme culture kicked in. It didn't matter that people, like the bank, was actually healthy. What really mattered is what people thought and the velocity with which this meme actually transacted across the economy. And there is no, like, one of the most insular economies in the world is that of Silicon Valley. And so it just took a few people to raise their hand and say, oh, no, this is a problem. And then at that point, the reasonable thing to do, the rational thing to do is actually pull dollars out quickly. And there were $42 billion worth of deposits within a 10-hour period. And so if you're a regulator, you don't necessarily just have to think about, well, what is the risk that this bank might fail and hurt the system? Now you have to think about, what is the risk that somebody has an idea that could cause the system to fail? What is the risk that somebody might come out and spout something that doesn't necessarily have to be true? Keep in mind, GameStop as a great business was not a true thing. SVB as an insolvent entity was not a true thing, but it was this idea that it could fail that actually led to the failure, and did so with a velocity that regulators just couldn't even contend with.
Alex, a lot of people talked about the analogy of what happened with Silicon Valley Bank to a prisoner dilemma, and basically saying that this was the rational thing to do. Do you agree with that?
So I'm going to push back a little bit on Chase saying that it was rational to pull your money out. And I can tell you what it was like from the perspective of a person who had some assets tied up in SVB at the time. I don't think this is a true prisoner's dilemma. A true prisoner's dilemma, if you cooperate with the police, you get to leave jail. And for the vast majority of deposits in a bank run like this, where the deposit size is like many millions of dollars on average, you do not get that. The vast majority of deposits are staying in the bank. You will not successfully withdraw them. So I think that you end up in one of like 2 or 3 scenarios. The first scenario is like, during the bank run, the vast majority of deposits are not coming out. They're just going to get stuck, right? There's a second bucket of people, which is like the people who decide to pull out just before the bank run starts. So I don't think this is a true prisoner's dilemma, because in the prisoner's dilemma, if you cooperate with the police, you actually get to leave jail and the other person stays in jail. And for the vast majority of depositors in Silicon Valley Bank, I don't think that was ever a plausible reality. The vast majority of depositors, when the treasury size is multiple millions of dollars, are not getting out of the bank during a bank run. This may be different if you are in like a consumer bank where the average account size is low, but that's not the way that Silicon Valley Bank is structured. As an entrepreneur who was watching this sort of explode in real time, I found it really frustrating, because it seemed like there are 3 options for you if you're trying to get your money out of Silicon Valley Bank. The first bucket is that you are in the bank run, in the middle of the bank run. You're not getting your money out in that case, right? If you're in the middle of the bank run, like 70% of depositors, 70 to 80% of the depositors those withdrawals are never going to succeed.
Chase, you're absolutely correct, but I don't think there is much for us to do about stopping memes, right? I think the internet is the internet, and we cannot really, have it behave. I think there were at least rumors about that there was some senator that called for like censorship of the internet to prevent the next bank run. I don't know if it's true or not, because it seems like a crazy thing to suggest, but the point is, it is a crazy thing to suggest. So the question is now, should we just now start thinking about a regulatory framework or a risk management framework that just has to take that into consideration, that yes, a meme can spread, and within 10 hours, $42 billion disappear. And this is just something that we have to account for. Go ahead, Steve.
Yeah, I think where I would go is, it is absolutely a classic bank run, as in the point of, you have your sort of George Bailey, It's a Wonderful Life, a bunch of depositors standing desperately trying to take all their money out. Where you're totally right, and a great point, Chase, is the velocity and the spread, the sort of blast radius of that has exploded, because I can't remember the town, but wherever George Bailey is in his little savings and loan, it's only the local depositors that are going to be there. Here, first of all, everyone's going to hear about it. Second of all, you notice you don't have to go to the bank and stand in front of the teller. You can just go hit a website and start taking your money out. So the reason $42 billion of deposits got drawn is because everybody could do that with a few clicks of a mouse. And so those are 2 things that are different this time, and the regulator is going to have to move on, which mostly means the regulatory response has to be that much faster. Alex, to a point you made, the end of the day, what still happens is a bank run, once it starts, inevitably nobody will get all their money. That's kind of the problem. That's why banks are inherently unstable in this kind of quantum state, is if you actually try and pull all the money out, think George Bailey, it's not there. It's somewhere else. And if you force a fire sale of the assets, you almost never get 100 cents on the dollar. So that means by definition, it's not there. And that's why we, in the end, have a regulatory framework, and that's necessary.
Is it actually rational for VCs to encourage their portfolio companies to pull out at any point in this process? Because it seems like the expectation is not, so first of all, I don't think there's any upside, right? You're not going to make money, generally speaking, encouraging companies to pull money out of Silicon Valley Bank. I think that the best case scenario is that during the bank run, essentially 0 people are getting withdrawals out, right? So on Friday, I'm not sure that I heard of anybody who actually got money out towards the latter half of Friday in the banking day. On the other hand, if you are a venture capital firm and you have hundreds of portfolio companies and you go tell them to pull all of their money out, the downside is that you will potentially cause a bank run. And I think one thing that is interesting about what happened at Silicon Valley Bank is it's not clear to me that the people who moved first actually did get all of their money out in time, right? By some accounts, Founders Fund was the first to warn their portfolio, and a lot of their portfolio did get caught up in it. And Rippling publicly got caught up in it. And part of their flagship product was tied up in the SVB fiasco. So when you look back on this, it's not actually clear to me that they did the right thing or they were materially better off for having told their portfolio to pull all the money out. I think it is somewhat likely that they actually played a significant role in catalyzing this and putting their most important portfolio company of this generation at risk. And I think if we're going to play this back in a couple of years, it's worth remembering that the people who were earliest to the table here didn't actually get all of their money out in time. I think if we were going to go back in time and play this back, it doesn't seem to me clear that it is worth it for venture capital firms to actually encourage their portfolios to leave the bank. I think it's probably at best value neutral, but probably actually positive expectation for everybody to just not do that.
But Alex, this is a very hindsight is 2020 moment, because we're all sitting here after the Fed stepped in and basically assure depositors that their money will be safe. We could have had a completely different narrative where, the powers to be in Congress would actually decide to fuck with Silicon Valley, basically, because their constituents, when they think about Silicon Valley bailout, they think that probably Larry and Sergey from Google are getting checks from the government and that the taxpayer is paying for it. So actually, I'm not blaming Congress for saying you know what, we actually don't want to be involved. And thankfully, the situation was, resolved in a good way for everyone, that all depositors were made whole. But it could have turned a very, very different way, and it could have been, fairly nasty.
Totally. But, in the event that, more than, I may be doing the math wrong on this, but I believe at the height, more than $1 million a second are leaving Silicon Valley Bank or people are attempting to wire out of Silicon Valley Bank, right? No matter what you do, no matter how you prepared for this event, those people withdrawing at that point in time are not getting their money. They're not. The only thing that is relevant at this point is whether the federal government is coming in to backstop the depositors. You're not getting your money out at that time. So at that point, that's 80, 90% of people trying to withdraw their money. At that point, it is not rational to add to the outgoing deposit balance sheet. That's just not, it's not rational, because you're never going to get your money out. It's way too late at that point in time. The only point in time where it is plausibly rational, and I'm going to argue it's still not rational, is before any of that actually starts. And the game that you have to play is, if you are a venture capital firm and you have 100 portfolio companies, or somewhere between 100 and 500 portfolio companies, you go tell people that they need to get their money out. I think the chances of you triggering a bank run are actually reasonably high, especially if you're a tier one firm like Founders Fund is. And my observation is that even in that case where they're among the first, perhaps the first firm to encourage people to withdraw their money, even in the case where their number one most important company in the current portfolio, the current outstanding portfolio, maybe the most important company since Facebook, has advance warning of this, even they didn't get out in time. So who's going to get out in time in the next bank run? Rationally speaking, there's no way this math doesn't work. Like that's the best case scenario. You have extremely sophisticated investor, extremely sophisticated company that is very important to that investor, and they're the first movers and they didn't get out in time. So like my proposition is it's actually not rational even to start. It's not rational at all to even suggest to your portfolio companies, because the downside risk is that you're going to obliterate 80 to 90% of your portfolio. That's the blast radius of this decision, right? So that's why I think no matter where you are at this point in the curve, I just think it's not rational to suggest that.
Let me pitch in a lesser known element of the game theory. There's a prisoner's dilemma, and then there's the blazing saddles game theory. There's that scene where the guy puts a gun to his own head and says, "Nobody move, or this guy gets it." And I think that's where there is some rational logic here, which is by hurting in that manner, the essential threat that Silicon Valley presented to the US Congress was, if you don't do something, we all blow up on Monday. And faced with the choice of blowing up Silicon Valley and doing something, the choice was obvious. So there's almost some rationality in the panic. But otherwise, I agree in the sense of if you think that by acting, you're going to get your money out, exactly the math does not work. But this is also, I think, why I don't expect people to say, "Oh, this problem can be contained," because in a situation like that, the logic actually is to go to maximum loss and threaten disaster on the portfolios of all those Congress critters. And in the end of the day, they will respond to that. I'll make one final point is, let's face it, everybody tweeting over the weekend, many of them have their congressman's phone numbers. A lot of them have their senator's phone numbers, and all of them are, air quotes, important and wealthy. This matters in this context, because if it had been some bank in Podunk, Nowheresville, we would not have taken care of it. But that's also sort of the reality of the situation and the system. And as we move up the stack in terms of the relative importance of these assets, and this is where you can take some small bank runs down here, but as it moves up the stack, the urgency to act and the proximity to somebody whose votes count starts to go up.
So Alex, I think the argument that you're making about this being an irrational decision to move first and withdraw money from the bank depends on, you're describing the prisoner's dilemma. And in a prisoner's dilemma is a multi-shot game where you respond to your opponents by doing what they did, and you learn from those opponents over multiple rounds. The problem here is this was a single shot game, right? Once I made the decision to pull the money out, there were no more cycles here where I could put it back in and we could try it again. And it was definitely, and one thing that enforced the single shot game is that on Friday morning, there were no more opportunities to pull money out of the bank. And so in that sense, the rational decision is to get the money out of the bank. And I can give kind of company A and company B anecdote, as someone who experienced this on one side, as an investor, company A got money out on Thursday and company A had payroll the following week and had no problem making payroll. Company B did not get money out on Thursday. And despite the fact that they had money, locked in this, in this fiasco, they had no dollars through which to pay their employees. And so to pay payroll was a non-option. And then, you're forced to come up with other options outside of, you're forced to come up with other options at that point. And so in that sense, the rational decision is to take the single shot, which is in a single shot game, the person who acts first is the one who wins. And this was a situation where to win, be able to pay your employee the following week, you had to act first. And I'll just leave everyone with a quote here and then I'll, pass the ball. But a wise friend had passed along a quote: when withdrawing from a bank, redeeming from a fund, or fleeing from an authoritarian regime, there is rarely much penalty for leaving early and an existential danger for being late. Just to add to that existential danger, on Saturday and Sunday and Friday, as investors in these companies, we are sitting around looking at all the information that we could from the smartest people on the internet and trying to figure out like how much of these dollars are we reasonably going to recover. And there were guesses as low as, 60%, as high as 90%, but there were none that were 100%. And so we are then in a position thinking to ourselves like, okay, this company that had 11 months of burn, now they've got 9, and they did nothing to get to the point of 9 other than being a depositor at this bank. And we've got to figure out new options.
Let me add on that in terms of actually quote Chase you mentioned. If anyone wants to know how it feels to be a CEO in that moment, I would highly recommend the movie Margin Call and to go and watch it. I actually watched it over that weekend to just remind myself that it can be worse than the experience that
You're a
I just
masochist.
that I just went through. And there's this brilliant quote from the character played by Jeremy Irons is like, there are 3 ways to make a living in this business: be first, be smarter, or cheat. And we don't cheat. So that is one of those things that basically being first. And I think, Alex, there was another thing that played a role. At least I can speak throughout this entire conversation. The one thing I can speak about is being a CEO of a startup that faced this dilemma. We also have responsibility toward our employees, and the employees, when it was Friday, they were asking, hey, Mr. CEO that is supposed to take care of our payroll, what did you do, right? And when we said we actually managed to pull the money out, like everyone started clapping, right? Because like, holy shit, like we probably gonna, have payroll, and the team acted well. And by the way, this is also, so we are fortunate enough to have full institutional VCs who invested in it. I was also looking to them for advice. And I have to say that the ones who gave us the advice of move fast and get your money out, now I have, respect for them versus the ones that say, oh, we're monitoring the situation and like we're sitting there idly. And then there was like other things that also happened over the weekend. There was many VCs firms that I was talking to all my founder friends over that weekend that also put money to make payrolls for the companies that couldn't take their money out. And there was like a lot of, I think, good behavior and bad behavior that was discovered during that one very short or very long weekend. But I do think that there is more to play than just like the prisoner dilemma aspect of what is your balance on your account at the end of the day.
I think it's really interesting that I started this conversation talking about how I think that talking about the primary actor as being like the VC firm that encourages their portfolio to pull out deposits out of the bank. And now we're talking about individual portfolio companies deciding whether or not to pull their deposits out of the bank. And I think this is actually a critical difference. My point is not that it is irrational for individual companies to pull out. My point is that it is actually not rational for VC firms to be the first firm to encourage people to pull out. And I actually think that is an important point. The reason is because they have disproportionate leverage over the rest of the ecosystem. So the fact that Founders Fund, which is a very sophisticated investor, suggests that it is time to move your money is enough, in my view, to trigger a bank run. And so when you do that, right, there isn't an upside. It's not like you're potentially going to make a lot of money triggering a bank run as a firm like that. Your maximum upside is that you trigger a run and then like 70% of your company treasuries are totally tied up and potentially completely gone, right? That is a bet that I just don't like. I am surprised to hear institutional investors make that. And when I hear people who are proud of telling companies to pull out, right, after like Founders Fund, my response to that is I think less of them, because it does not seem to me that is a good risk calculus. The idea that you would potentially cause something that tanks 70% of your portfolio treasuries is just totally crazy. I don't understand how you make that math work. For individual companies, I think it's different because when you are making a decision about your employees' payroll and stuff like that, like I can understand why if founder's fund is telling you like there is going to be a run on the bank or something, you can understand why a founder would be like, well, I don't really have that much information or that many choices, and I'm going to pull my money out. Like, I can understand that decision. I don't understand why you would be the first the first firm to say something like that.
Alex, I think that's a really good point. And let me try and give you a let me give a counterfactual as to what else could have happened where I do agree with you is, it's Wednesday last week. Everyone's getting worried. All of these VCs, and there are not that many of them, have each other's phone numbers. And they all get on a conference call on Wednesday night and they say, folks, we have a problem here. And they call up the head of Silicon Valley Bank and they say, look, buddy, you need to go raise more equity. We'll kick in a small amount. You need to go do it. I don't care if that's at 1 penny per share, or we're going to pull our money. And it's a little like the famous 1907 thing where JP Morgan stepped in and saved the US banking system. Collectively, a relatively small number of VCs who know each other, have dinner together, hang out a lot, could have acted collectively in order to prevent this bank run, as opposed to going through the process of the bank run. Because practically speaking, there are ways that Silicon Valley could have been made whole and those assets could have been saved. So there is a tremendous failure of collective action. And you can't sort of pretend that it was an uncoordinated mob. It's actually a relatively small number of people sitting on extraordinarily large chunks of money over which they have influence. And you do have to say that is a collective failure of people who do know better and, more importantly, have the means to coordinate.
I want to push back a little bit. I wonder if it was a collective failure or was it actually a collective success? Because one thing that will happen, and I would love to hear more from you, Chase, as a VC here, is I think we now understand the risk of having one bank serve an entire economy, right? And maybe Silicon Valley was just doomed, to die, and we just actually accelerate that. And I think one of the things that will happen out of that is people will move to other banks. Unfortunately, for some parts of the economy, it probably will be the largest banks in the world, but banks that are not just exposed to, those movement where basically 10 VCs can hop on a call and completely crack a bank. Maybe that's actually a good thing.
I'll take the other side of that equation, which is, a bunch of those VCs also are proud libertarians. And it's funny. There's never a libertarian in a crisis. They're always, it's like there's never an atheist in a foxhole. So where I'd kind of push back on that is there was a lot of value and a lot of worthwhile stuff that came out of Silicon Valley Bank exactly because it was so specialized in tech. And it is sort of a one industry bank. The problem is the people in that one industry need to make sure that that bank is boring, dull, low margin, and doesn't take crazy interest rate bets. And that requires this awful, horrible thing, which absent last Wednesday, everybody in Silicon Valley likes to pretend they hate, which is regulation and or somebody stepping in and making sure that this thing doesn't get over its skis. So there was a tremendous amount of value and still is a tremendous amount of value in having a single industry bank. The issue is deluding yourself that can happen in some fantasy free market when banks are inherently non-free market creatures. That's, I think, where I'm going to push it back again on a collective group of people that on their good days when the world isn't falling apart, really love to pretend that they don't need that horrible people and regulators in Washington slowing everything down. If those horrible regulators in Washington had been allowed to do their job at below 50 billion in assets, we would not have this problem.
Vitaly, so am I understanding your position basically that it is better to co-locate all of the risk to the big four? I mean, that seems like a more systemic problem. Like if like Morgan Stanley or something is ever under serious threat, right? Like that could potentially be way bigger than like some regional bank that just happens to have like a bunch of Silicon Valley deposits. Is that really what you want?
Yes, the question depends on the context and the framing that you're looking for. I'm saying for the entire world, obviously, we don't want like all of the rest to be with 4 or 5 large banks. But I'm saying for an industry, I think that was like having like, I don't know, 50% of 50% of the SARBs. It's not exactly 50% of the capital, but from one of the largest growth engines of the economy, having all of that money in a single regional bank that, to be quite honest, was way over its skis and had no business of like managing that much money, right? I think that was a risk that should have been mitigated. And my prediction, and I don't know if Chase, you folks have this conversation with, like every single subsequent term sheet that will now be issued for, over a certain amount will now have some provision in it that you need to hold your money in, what is considered a safe and a bank that is just not that concentrated for this particular economy.
I think it's too soon to state whether there'll be a ripple effect on term sheets, or at least hasn't been something that's entered the discourse at the firm I'm at. But you do make an interesting point around, big banks versus like small banks and what concentration, what would be the impact of everyone being with like one of these large banks versus just being a very fragmented model. If you look at the banking system in the United States, we kind of have like three classes of banks. We have those that we'll just stick with round numbers, but those with fewer than $50 billion in assets. And we'll call these like the small banks, the community banks, the local banks. And these ones, by definition of their size, are not systematic. Like if the bank in my parents' town in the middle of Oklahoma goes out of business, like we're never going to hear about it in Silicon Valley. All right. Then you have the large banks above 250 billion, which are the systematically important financial institutions, the CIFIs or the CFIs. I don't know what how we're pronouncing the acronym. That, if one of these banks fails, this will cause a global recession, which is something that we started to see inklings of in 2008. And so for that class of banks, we have enhanced regulatory oversight that's substantive, right? The problem is we have this kind of mid-market, right? This 50 billion to 250 that doesn't have the regulatory oversight of the 250 that we've learned is actually systematic, in the sense that when SVB went down, there was real risk that we were going to see, a very scary ripple effect from that. And it was in this no man's land. And so the question we should ask is should we be regulating these mid-market banks, or should we have a system that, where we have either all large or a bunch of small ones, or all the above?
Chase, let me follow on with that. And it's a little conspiracy theory, Shandor. It's kind of the logic of all banking markets. The US is really unique in having so many banks. Most places, one reason Credit Suisse caused so much trouble this week is because it turns out Switzerland has two banks. There's UBS and Credit Suisse. That's basically it. Plus all these little private banks. The US is really unique in having this large number of banks. You will also notice that if you're one of that magic top group and you're too big to fail, the bad news is you have more regulation. The good news is you feel like you're untouchable, and your only potential threats are that middle group that you just described. And so you can step back and say that, broadly speaking, if I'm sitting at JP Morgan Chase, would not be deeply unhappy if we ended up in a world where there's me, and then you drop down to the 50 billion banks out in Oklahoma, and there's nobody threatening me in the middle. Now, from a free market perspective, this isn't a good thing, because big fat people at the top then get big fat, lazy, and profitable. From a shareholder perspective, this is great, because big fat, lazy, and profitable is a good thing to own, or podunk down here and I don't need to worry about it. You can see here there's a public policy value of trying to maintain that middle. And you can also see some pushback of, hey, maybe we can just clip out a few of these guys along the way, or buy them for cheap and consolidate the banking sector further. And there is somewhere out there, there's been a multi-year agenda to that effect. Because as you can remember growing up, there used to be a lot more bigger banks, and they've all slowly glommed into such few very large ones. That's probably where the trend is heading. It's not necessarily good in terms of people who are better served by, for example, a highly specialized bank like Silicon Valley Bank.
I actually do think that we need the middle market banks, because they do create a competitive environment for the large banks. Like whenever startups think about where to put their deposits, they are making decisions between these middle market banks like SVB and First Republic, and larger banks like Bank of America and Chase. And so I do think we need that. I guess my point is, if we're going to have it, we need to regulate them now that we've, as if they were going to be systematic, because we have learned that they actually can be through this SVB debacle.
And Chase violently agreeing with you, which is we need those things. And it's more just, I'll just say there is a group of people out there that would not be sad to see them go away, and not for reasons that are good for the nation or good for the health of our broader industry or good for the macroeconomy. It's purely simply because then I'm that much more secure in my dominant position in the marketplace. If I were to try and take a weird metaphor, it would be like tech right now is dominated by Google, Facebook, a couple of really big players. And to some extent, they crowded out the space, or used to. We'll see if that's changing now, underneath for mid-sized innovative companies to come out from underneath their shadow.
This is kind of the point also on the banks is we probably should think, and this might not be even a regulatory problem. I think maybe as Silicon Valley insiders, right? Is it safe for us to have a systemic risk? Because to be honest, like until last week, I would never have guessed that the thing that can bring, the collapse of Silicon Valley will be this like one regional bank that, goes down, right? And we were, at least for me, too close for my comfort to that actually happening, right? Like Chase said, we could have got not the problem is not so much 50% on the dollar, is like just how long would it take you to get that 50% back, right? If you just were given a creditor note and then you have to go and fight the system in order to get all of that money back, that would kill thousands and thousands of startups, right? So what I'm saying is like if we have such concentration, and this is like in software architecture, if you have the single point of failure, like this is where we should diversify the risk. And what I'm saying is that it doesn't have to, all the money should go to Goldman. Like maybe we should find 50 regional banks, and like I think some banks are doing, and deposit there to get the FDIC insurance or whatever the hacks are in order to guarantee the safety of the system. But I would say that now I look at Silicon Valley very, very differently in terms of the risk profile than how I was looking at only a week ago.
But I'll take the other side of that, which is, like I said, like Silicon Valley Bank offered a huge number of really specialized services that were uniquely valuable and uniquely useful to the ecosystem. I think, though, to your second point is, did anyone in that ecosystem appreciate, number one, how central they were, and number two, pay any attention to how vulnerable and fragile they were? So there are two choices. We can sort of spread our deposits out over a bunch of people who are not as good at serving startups, and the ecosystem will suffer on that. The alternate approach is to realize that we have a single point of failure, and from a software perspective, just make sure it's absolutely bulletproof. And that means boring, low return, heavily regulated. And that's, I think, where Silicon Valley has been caught out sort of talking both sides of its mouth is, if you're going to have that, it's a little like I'm a network guy, right? So the network had better never go down. And if that means it's a single point of failure, it's a single point of failure. You better make sure that thing's boring and well regulated.
Oh, it's kind of interesting to hear you talk about this, because earlier, I think you were the one who said that, banking regulation is fully prepared for 2008, but we're fully prepared for that risk profile. And hearing you describe like the risk profile, like the things that we've learned about the structure of banking for startups, it is not obvious to me that as the ecosystem matures, that lesson is going to be sufficient for building a system that doesn't have but I wonder if there, to what extent we can be assured that whatever replaces the current system is really going to be resilient in all of the ways that it should be for all of the future potential liquidity risks, which is how I think of this.
But this is actually, we have capital allocators in the system, and the good thing about them, they're actually fairly influential, and also somewhat also concentrated, that they can actually start thinking about the problem. Because like I said, from all the things that could have happened, like I think the collapse of Silicon Valley Bank was not at the top of the list. And I do think that now we need to start thinking about what other things could go wrong that will topple the entire industry down. And it's actually not that crazy to have an industry board that thinks about those things, right? Every single other industry has something similar, and I think there probably something for VCs as well. And but maybe that is now time we're gonna start paying more attention, because the way I look at what happened last week is we avoided a mega crisis. And to be honest, I don't want to trust that we will be that lucky next time.
I got a good metaphor, since large chunks of the South Bay seem to be out of power for the last 2 days, is because it's very similar metaphor is I think though, I agree with you. The industry needs to be a little more responsible. There's two weird things about Silicon Valley: constant power outages, and there's huge chunks of the place where you can't get decent internet. And yet there is no collective action to make sure that those basic utilities, in this case, literally, are functional. And I think there is this strange idea that it's somebody else's job to provide that. And I live in Berkeley, so it's not my problem, but I do find it weird.
Let's try to figure out what is the solar equivalent to Steve's kind of PG&E problem, and how can we actually be a little bit more self-sufficient and figure out ways that we are not carrying that much of a risk. But for today, Steve, Chase, Alex, thank you so much for joining us on this impromptu episode to talk about all the fun things with Silicon Valley. And for all the listeners, thank you for listening.